Welcome again. I'm Jason Webb, Deputy Global Managing Editor at MNI. Delighted to be your host. I extend a particularly warm welcome to our speaker, Tobias Adrian, Financial Counsellor and Director of the Monetary and Capital Markets Division of the IMF. Tobias last spoke at one of our events back in January 2020. It's hard to recall, but that was just before COVID struck. As we grapple with the inflationary aftershocks of the pandemic and the tragedy of war in the Ukraine and now the Middle East, Tobias joins us to discuss a subject that's never too far from the surface as market interest rates continue to rise: the health of the financial system. Indeed, it broke through the surface last spring, particularly in the United States. Tobias will now make some opening remarks to follow up the IMF's publication of its latest Global Financial Stability Report, before I engage him with some questions and observations. I invite our audience to please enter questions in the chat box, which you can find on your toolbar. We'll be monitoring these and raise these as appropriate as we go along. I confirm that this MNI webcast is fully on the record. Our speaker leads the International Monetary Fund's work on financial sector surveillance, monetary and macroprudential policies, financial regulation, digital money, bank resolution, debt management, and capital markets. He also oversees capacity building activities in IMF member countries, particularly with regard to the supervision and regulation of financial systems, bank resolution, central banking, monetary and exchange rate regimes, central bank digital currency, and debt management. Before joining the IMF in 2017, Tobias Adrian spent 14 years at the New York Fed, where he was Senior Vice President and Associate Director of the Research and Statistics Group, contributing to monetary policy, financial stability policies, and crisis management. Holding a PhD from MIT, he's taught at Princeton and New York universities and has published extensively in economics and finance journals. Thank you, everyone, for your attention. This MNI webcast is scheduled to run for up to 1.5 hours in total. And I now hand over to Tobias Adrian to get us underway. Tobias.
Yes, thanks so much, Jason. Very happy to be back here. And as you say, it's quite incredible that nearly 4 years have passed since I came last time, and that was pre-pandemic. So what an unusual time. So what I was thinking I would do to kick it off is to present our current global financial stability assessment, which is based on the GFSR, but to also start with some messages from the World Economic Outlook, so more focused on global growth as a backdrop, because it's so important at the current conjuncture to understand financial markets, really to look at the macroeconomy as well. So let me share my screen, and then I'm going to go through the slides. So the GFSR was published just about 2 weeks ago at the annual meetings in Marrakesh. And here is our high-level messaging, and I'll go deeper into each of these items. The number one theme in terms of moving markets is whether we will see the soft landing. So our baseline is one of a soft landing globally, but there are risks around that baseline. And financial stability is always about those risks around the baseline. So the good news is that inflation is easing around the world, a headline in particular, but even core inflation is coming down, in most countries, in some countries more quickly than in others, but the direction of travel is the right one. There's still ways to go to get back to target, but the direction is the right one. And of course, the global economy is losing momentum, which is the intended consequence of tighter monetary policy, right? In order to get inflation down, you have to slow down economic activity. Of course, the supply side also has been improving. Part of the rise of inflation was both on the demand and the supply side. And we now see movement back in both demand and supply side. Now, financial stability risks remain elevated, and I will make that statement very quantitative in a couple of slides. But we do think that by historical standards, we're still in a zone of elevated risks. Earlier this year, we saw acute stress in banking, a turmoil in banking, particularly in the US and in Switzerland. And so we took another look at banking stability, and we have a whole chapter on a global stress test of banks, where we basically find that there's a fat tail of weak banks, pretty much spread around the world. So it's very broad all over the world. Despite the declines in equity prices since September, and due to rising long-term yields, there is still a possibility of further repricing. So, of course, long-term bond yields have been rising. In the past couple of days, they have come down a little bit. But when you look since the beginning of the year, it's really a dramatic rise in bond yields. This has been orderly, but it clearly has changed the borrowing cost for governments, in particular the far and the future borrowing costs. Again, I will go more into detail. And so stock markets have normalized to some degree. There has been some sell-off, but our metrics still sort of suggest that stocks are stretched. So, and of course, credit spreads are still pretty tight. So there is a risk of further repricing. Emerging markets remain resilient, in particular the major emerging markets. China is a bit of an exception here, but major emerging markets are very resilient, and they have been resilient throughout those 4 years. It's really very impressive. But of course, low-income countries are facing a lot of stress. So there's a very pronounced distinction between the major emerging markets that are very stable and then smaller, more fragile emerging markets and low-income countries that are under a lot of pressure. Again, I would say more to that. And the last thing I would point out is the global credit cycle. So we do see that credit is deteriorating. It depends on the sector and the country how much that is, but certainly the direction of travel is one where credit losses and defaults are rising. So let me go into more detail on the global financial stability. But before doing that, let me just give a couple of messages from the World Economic Outlook just to set the macroeconomic backdrop. So the global economy is resilient. It's actually surprisingly resilient. So data continues to come in very strong, in particular in the US, but also in many other countries. So here we are showing you in the left chart the world real GDP growth as of October this year. That's the thick blue line. Compared to July, there's a little bit of a change, but it's marginal. But compared to April, it's really quite pronounced. So a lot of the downside risk has been taken out for 2023 in particular. 2024 is perhaps a little bit lower, but of course there's some margin of error. So when we're looking at the revisions, that's the middle chart, you can see that for 23, it's primarily emerging markets, except China, that have been upgraded, and the US has been upgraded, while the European economy and China have been downgraded. And then for 24, US has a huge upgrade. Emerging markets ex-China, a small upgrade, but again, the euro area and China have quite substantial downgrades. So these are fairly large magnitudes in terms of forecast revisions. As I said earlier, inflation remains above target, but is moving in the right direction, and the dispersion of inflation is also coming down, as you can see in this chart. Now, we have been subject to these massive common shocks, right? So First was the COVID shock that hit every country, supply chain disruptions, as well as shocks to demand. Of course, a very synchronized, not really coordinated, but very synchronized monetary policy easing and fiscal policy easing as a result of COVID and to cushion the adverse shocks from COVID. Then, of course, inflation that was very broadly spread, led by commodity prices, but then feeding back into broader prices, including core. But now we're sort of like going into a world where divergence is reappearing, and that's the more normal picture. So the last 3 or 4 years were probably somewhat of an outlier. And so you see, for example, here China on the left chart, where fixed investment has dropped quite a bit, real estate investment has dropped, and of course consumer confidence has dropped quite a bit. The middle chart shows you the level of GDP relative to the pre-pandemic forecast. So go back to January 2020 and look at the forecast we did for all these regions. So here we show you US, advanced economies without the US, emerging markets without China, and China and low-income countries. And you can see that basically only the US is back to where we would have expected it to be in terms of levels relative to pre-crisis. This is followed by other advanced economies, but there is a gap of about 1 percentage point. And then China has a notable gap of about 4%, and other emerging markets also have quite a bit of gap. And low-income countries clearly have the biggest gap. So one, remarkable fact on the right side is this correlation between GDP growth and energy prices. So the x-axis shows you the change in consumer energy prices since 2019, scattered against the 2023 Q2 GDP growth. And you can see, that this cumulative energy shock since 2019 continues to be the number one explanatory variable for growth dispersion, and you can see there's huge dispersion across countries. Now, core inflation is slowing. The left chart shows you the US in blue. And then the median country, so this is core inflation for the median country, together with the average, which is a little bit above 2% from 2010 to 2019, and you can see very, very nicely the run-up of core inflation and then the coming down of core inflation. So we're not quite back to the pre-crisis average, but we're getting close to that. And of course, as I mentioned earlier, it is both supply and demand. So you can clearly see that food and commodity prices shot up and are coming down. For any one country, these are sort of like exogenous variables, but of course for the world as a whole, these are very much endogenous. So as economic activity is slowing to some degree, we do see that those prices are coming down. So it's a combination of supply chains, of course, as well as global demand. Now let me turn to the markets part next. So this was sort of like the opening part from the World Economic Outlook. So now let's take the markets perspective. And here what I'm showing is the inflation for advanced economies. I'm going to show a similar chart for emerging markets on the next slide. So this is advanced economies. So I picked here US, Euro area, UK, and Canada as a representative sample of advanced economies, covering both the major economic areas, US and Euro, and then two important other G7 economies, UK and Canada. And so what you can see is that the market was persistently optimistic about inflation coming down. So as inflation ramped up starting in 2020 and then really in 2021 and 2022, markets kept expecting that inflation would come down. And of course, that only really happened starting late last year and then really this year. So finally, we see that these expectations actually align with the realized path. So that's a good thing. And that's also true for interest rates. So the market kept expecting that interest rates were going to come back down or were leveling out. And it's only recently that is the case. So basically, markets were persistently optimistic in terms of both interest rates going forward and inflation going forward. And, the theme of higher for longer is very clear here, right? So, clearly there is an expectation now that interest rates will stay at elevated levels for some time as inflation is coming down. But of course, there could be shocks to inflation. So, hopefully that's going to be, the path going forward. That's the central path. But of course, there's a huge dispersion around that central path. In emerging markets, and so here I'm showing Brazil, Mexico, India, and Poland. So Brazil and Mexico, of course, are notable. Brazil in particular, this was the first country globally to start tightening, right? They really got the timing right. But they did have a very, very sharp run-up in inflation. Again, markets kept expecting inflation to come back down much more quickly. And it is coming down, pretty dramatically. And Brazil is also one of the first countries that started cutting already. So you can see here the rate cuts that are plotted here. Mexico at the moment is holding steady, but there's some expectation of cuts. And you can also see that inflation has come down quite a bit. India, inflation never really rose. And Poland, as our representative for Eastern European emerging markets here, also has a similar picture to the advanced economies with, rates starting to be cut and, further expectations of cuts. So that's the inflation picture. Now, what we have seen in recent months is a pronounced rise in term premium. So the left chart shows you term premium. So these are 10-year term premium in basis points for US, Germany, UK, Japan, and Brazil, Mexico, Poland, and Indonesia. And you can see that term premium have come up everywhere, with Poland as the only exception. And in the US, it's really remarkable. It's over 100 basis points. So this is since April. And if you go back further, it's even more pronounced. So there's so when we think about 10-year rates, we decompose them into expected future short rates, which is the blue part, and then this term premium component, which is the risk premium that investors earn. And you can see, a pronounced shift here, change in those term premium. For Germany, it's not as large quantitatively. UK, it's not as large. For Japan, it's quite pronounced. But also Brazil and Mexico, a pronounced upward move in term premium. And you can see that for Brazil, for example, expected short rates over the next 10 years have been revised downward sharply, while term premium have been revised upwards. The right chart shows you a further decomposition of that, decomposing the 10-year into the 5-year and the 5-year forward. So these are far in the future expectations. And then breaking down the 5-year and the 5-year forward into a real term premium, an inflation risk premium, and then expected inflation going forward and expected short-term real rates going forward. And you can see there again that it's both at the 5-year and the 5-year forward. It's the term premium that is the major move. And this is also decomposed into April to October and then September to October. And you can see that, April through, yesterday, and then September through yesterday, and you can see it's term premium everywhere. So it is really a repricing of risk. And of course, quantitative tightening or expected quantitative tightening or runoff of balance sheets is one component, and then fiscal uncertainty and the level of debt is the other sort of driver of that. So our baseline global financial stability assessment is really shown on this chart here. The left shows you our growth at risk. So that's the forecast density for growth. So this is centered around the wheel forecast. So the red line is the mode of that distribution is the global growth forecast. And you can see that the mode is lower than the unconditional mean. So that's the unconditional mean since 2020. So the growth distribution, the unconditional one, has a higher mean and lower dispersion, and in particular lower skewness. So currently we see a low mean and high dispersion. So that means that our metric for financial stability risks, which is the 5th percentile, has a low level of growth, so it's 0. Whereas normally the 5th percentile is around 2%, right? So 0% growth as a 5th percentile is high downside risk. So the middle chart shows you the time series of that downside risk. So it shows you the percentiles of how this 5th percentile moves over time, shaded across the historical percentiles. And you can see here, we're not in the totally red area anymore. Last October, we were in the really red area. So we've moved up a little bit, but it's still, we are at an elevated level of downside risk. The right chart shows you the Goldman Sachs Financial Conditions Index. This is, available in real time across many countries. You also have a financial conditions index, but it's not quite as real time. And so you can see here that financial conditions have tightened quite markedly in the US, Euro area, but also the US as term premium have tightened. Now, one of the drivers of our concern about financial stability is our assessment of banks. So in the baseline, which is the green line here, very few banks have capital below, a cutoff, which here we use at 7.5%. So it's 5 plus 2.5. But in an adverse scenario, and here the adverse scenario is country specific. So we look at 29 countries, 900 banks. So it's a massive sample. In the adverse scenario, which is one where global growth goes down 2 percentage points, and inflation is more persistent. So interest rates are up 2 percentage points relative to the baseline for many years into the future. 3 years is our forecast horizon. You can see that there's a fat tail of weak banks. And so the right chart gives you some of the magnitudes here. So, in the baseline, very few banks falling below the buffer. But in the adverse scenario, it's basically more than 30% by assets. So many banks are in distress. And this is, by the way, very, very broadly spread across the world. So this, I think, is number one concern, is the banks, are not in turmoil right now. In the baseline, we think they're fine, but in adverse scenario, there could be stress. Second concern, when we look at the cumulative year-to-date returns in the S&P 500, the run-up, there has been some correction, but the run-up is primarily due to equity risk premium. So that's risk appetite. So that's the unexplained component, right? So this is the residual relative to controlling equity prices for earnings expectations and discount rates, risk-free rates. So it is the residual, i.e. the risk appetite, that has been driving valuations. And so that could potentially revert, even if earnings don't change. And a similar picture emerges when you look at corporate bond spreads. In advanced economies, here we look at the US and Euro area, they remain very tight. They have widened a little bit, but they're very tight by historical standards. Now, the credit spreads do look different when we look at emerging markets. So For investment grade emerging markets, that's the green line, the story is also true that spreads are very tight. So they've widened slightly in the last couple of weeks, but they're very tight by historical standards. But for high yield emerging markets, the story is very different. So emerging markets that are risky have seen a pronounced widening of spreads. And, that is very tightly linked to fundamentals, right? So many smaller, riskier countries have high debt. Many are in negotiations for debt restructurings or in programs or near programs. So the right chart shows you a distribution currently in yellow, the distribution of secondary spreads for high yield issuers. And you see there's a huge bunching of issuers with spreads above 900. So this is like distressed levels. So 20% of these high yield sovereign bond issuers have these very high spreads compared to sort of like an average distribution conditioning on high interest rates, right? So even conditioning on high interest rates, it's quite unusual to see so many high yield issuers having wide spreads. And so when you look at portfolio flows, there has been some slowdown. It's not a dramatic reversal. So it's nothing like, the taper tantrum or so in 2013. There's some slowdown, particularly related to China, but also some weaker emerging markets. And of course, hard currency bond issuance has been slowing down. Markets are not shut, but it is expensive for riskier issuers. Now, turning to corporates, there's more and more sign of some stress in the corporate sector. So the left chart shows you these interest rate coverage ratios, which are deteriorating. Right chart shows you firms with less cash than interest expenses. So there's deterioration. You can do different cuts for advanced economies, emerging markets, large firms, small firms, but the picture is pretty universal. Of course, for households, we do see that housing prices have come down dramatically in some countries, but not all. Japan has seen an increase in housing prices. Of course, Japan is somewhat of an outlier. But countries like Canada, Sweden, Germany have seen a pronounced decline in housing prices. This is just a 1-year snapshot on the left chart. And then CMBS have been, of course, in focus. You can see on the right chart that these CMBS default rates are shooting up. They're not anywhere close to post-2008 levels, but the direction of travel is clear. Now, concerning property developers in China, I already mentioned China, so you can see that sales volumes are down, particularly for these distressed private firms. They're in the newspaper. The state of firms have stabilized, as the green chart shows, slightly lower than prior to the pandemic, but roughly stabilized. One thing that perhaps isn't discussed as much is the regional divergence in housing. So here we are plotting the LGFV bond yield. So these are the local government financing vehicles across provinces. So these are the bond yields. And then the y-axis are the yields on subordinated debts of local banks. And you can see like Beijing, Shanghai, Jiangsu, so the very strong provinces, have very low interest rates. Whereas, if you go to the periphery, you do see quite a bit of weakness. Ningxia, Ganzhou, Yunnan, Qinghai. And you see that it's, there's quite a strong correlation across these provinces between the level of local government financing bond yields and provincial banks, smaller banks. So there's some nexus between the provinces, the local banks, and the local housing markets. Of course, the trust assets have some exposure to real estate as well. So, some major asset managers have suspended redemptions. It's another area we follow closely. And coming to the end, sorry, I'm a little bit slow. We do look at climate finance as well, and we point out that there's a big gap. If you want to hit those IPCC targets, i.e., transitioning to net zero emissions, you have to finance a lot of new investment expenditures. And there's a big gap in between the financing that is visible right now and what would be needed annually to get to net zero. So let me stop here and return to Jason and start with the discussion.
Thank you very much, Tobias. It was extremely interesting. And first, I'd like to invite those who have not already done so to send questions to our chat. We've already got a couple of questions, which I'll turn to quite soon. But there are a number. Obviously, there are a great number of themes there. The rise in term premia, bank weakness, which many might say is surprising given the Basel III reforms and so many years after the reforms of the regulatory crisis. And also another theme which I picked up in the report when I read it was the very downbeat turn on China compared to previous reports, and of course the a particularly bad performance by some Chinese banks in the stress test. But just starting off very, very broadly, given that the financial crisis is now many years, many market participants probably were still at school during the great financial crisis, and the enormous regulatory efforts which followed and the new architecture put in place after the financial crisis. Isn't it, what has gone wrong very broadly? Why are we still here? Why? I think if we looked at the bank stress test in the adverse scenario, you mentioned 30% seeing some capital weakness. And I think that there was another figure of 42% of banks classed as weak, which also included some measure of the speed of decline of capital as well in the adverse scenario. So what could we have done better in the after the global financial crisis, I suppose, and what can we do going forward?
So there are trade-offs in regulation, right? So the Basel Committee decided on a level of increasing capital that was a judgment about those trade-offs. We have seen a pronounced increase in bank capital since 2010, since these reforms were being phased in. Of course, Basel III is not fully phased in yet, but there's definitely more capital in the system. There's more long-term debt in the system. So I think there's no question that banks are safer today than they were 15 years ago, right? I think there's absolutely no question. And in addition to higher capital, of course, many of these off-balance sheet capital arbitrages that were so pronounced in the run-up to 2008 have been completely shut off. And it's a combination of regulatory changes and accounting rule changes, right? All these SPVs that exposed many banks to the decline in the subprime mortgage market, they just don't exist anymore. So I think there's no question that banks are much safer. Now, are they safe against anything? I mean, no, they're not. Again, there are trade-offs. We have seen in many countries, not in all countries, that the non-bank credit intermediation has grown quite a bit. And, to what extent that is directly associated with capital regulation, I think is still something that is quantitatively being assessed. There's sort of like a common belief that there is some effect of that. How much it is, etc., is hard to precisely point to in the data, but there's certainly some trade-offs, and I think that is one of the main dimensions. So, so stress tests, of course, have become a major tool for supervision, right? So there's regulation, and then there's supervision, and supervision. Their stress tests both on capital and liquidity have become very important, and for some banks in some countries are the binding constraint in terms of capital and liquidity. Though in general, it's the regulatory constraints that are more binding. So I think what we're finding is very much aligned with other stress tests. So it's not that different from other stress tests. I think what we are doing differently here is that we're looking at the whole world, and so looking at it, from the global perspective is perhaps a little bit more impressionably. But in terms of magnitudes of capital losses and the fraction of banks that are undercapitalized, I don't think it's that different from, say, a stress test that other institutions have published. Now, we do focus particularly on three things. So one, the weak tail. So what's the magnitude of this weak tail, as opposed to just looking at the average level. And I think that's very important, and it's one of the lessons from March of this year, is that even if on average it looks pretty good, we do have to worry about the weak tail, because there could be spillover across institutions in the weak tail. Secondly, we try to understand really in detail how much marking to market or not marking to market these hold to maturity portfolio matters. And then thirdly, how liquidity runoff could put pressure on institutions. So we're looking at the solvency and liquidity nexus quite a bit. And so we're running reverse stress tests for these runoffs. So one of the interesting findings in the chapter is that, liquidity backstops are extremely valuable in most banking systems. There's a variance on how much value the backstop has. But in general, central bank backstops are extremely important.
But overall, is it fair to say that your judgment is that global banking system requires more capital overall? And the report, for example, points out that Pillar 2 tests are procedures are a little bit hit and miss in terms of a little bit too subjective, perhaps, in terms of the amount of additional capital required. And also, obviously, the US problems point to how many banks were outside of the Basel of the big Basel III rules. So overall, the global banking system requires more capital, do you think? And if so, any idea of how much?
So we are not calling generally for more capital at this point. So we do recommend that countries where there's tailoring by bank size, that all banks should meet Basel III requirements. So in the US in particular, we did a financial sector assessment back in 2020, where we looked at this tailoring by bank size. And we recommended to bring all the banks up to Basel III standards. And the fact the banking authorities in the US have proposed changes to the regulatory approaches that is bringing institutions to those standards, and to some degree even higher than that. So I think that's very much aligned with our recommendation. And there are other countries around the world where these Basel III standards are not applied everywhere. So our recommendation is to bring everybody up to the minimum. We do also recommend that supervisors use stress tests actively in order to assess the degree to which perhaps more capital would have to be required. So, as I said at the beginning, in principle, stress tests can be the binding constraints in terms of capital, and that has been the case in some countries. And of course, the Basel Committee, which is the body that is overseeing these minimum standards. The Basel Committee is, of course, looking at interest rate risk, how that is being managed, and at runoff rates for liquidity. So it remains to be seen what the conclusions of the Basel Committee are on these issues.
Thank you. And you mentioned, of course, that some of this, there is an indeterminate amount of risk, which then migrates into the non-bank financial sector, as it appears, as some of this, as this regulation in banks is tightened. But I'll go back to that later. Now, I should note that we've received a number of questions, but before I move over to the audience's questions, I wondered if I could just ask you something which touches on the issue of term premia. And of course, one of the term premia formula is named partly after you as well. So so you're obviously an expert on that. When in the report, we mention, or you mention, that the investors still seem to be underpricing the possibility of a hard landing. Still seem to be a little bit sanguine, and this is what financial market assets are indicating. Since the publication of the report, the S&P's come down, S&P 500's come down a little bit. 10-year yields have gone up about 20 basis points in the US. But do you think that this relatively sanguine reaction by financial markets is partly a response of markets conditioned by many, many years of easy, very easy central bank policy, and by the idea that a central bank bailout is always around the corner? And if this is the case, does this increase the danger of some sort of non-linear fallout when the market wakes up and realizes that the dream of central bank bailouts is over? Oops.
I was muted.
Okay.
Yeah, so I wouldn't. So let me rephrase a little bit. So
sure.
So we do welcome the tightening of financial conditions. We felt that the easing of financial conditions as interest rates tightened was somewhat odd. And so here, when we think about financial conditions, we sort of think about the market price of risk. We always think that the effective funding costs for corporations and countries is a combination of the risk-free rate and then exposure to this market price of risk. So it's kind of like a risk-free rate plus a spread, and the spread depends on how much risk exposure you have in the aggregate. So that's all like the basic financial economics thinking around the marginal cost of raising stock or bond capital, or even for households borrow. So interest rates were being tightened, but financial conditions, so the market price of risk, was actually coming down quite a bit. And we felt that was a tension. There was sort of like this optimism and risk appetite, right? It's not just optimism. So there was, the baseline of a soft landing, which we share, right? Our baseline is one of a global soft landing. Not every country has a soft landing. Some countries are already in recessions. Some other countries may be in recessions. But the global economy is sort of like the baseline is one where the economy is slowing down, but it's not going into recession, while inflation goes back to target, right? So that's the baseline, but that has been accompanied with, tighter monetary policy while financial conditions were easing. So quite a bit of optimism, and that we felt was a tension in markets. So term premia have widened. Different models. Have slight differences in the exact magnitude of the term premium, but the direction, the change is certainly, very similar across different models. And so, yes, I worked on a model about 10 years ago with my colleagues, Richard Crump, who is at the Federal Reserve Bank of New York, and Emmanuel Mönch, who was there, who's now in Frankfurt as a scholar. And so that model is updated daily at the New York Fed, and you can pull it from Bloomberg. And so you can see sort of like a long historical time series going back to the 60s with daily data of term premia. So you can do lots of analysis, at different maturities. And, we are widening the term premium. Now, you're mentioning the post GFC period. Of course, QE had this explicit transmission mechanism to compress this term premium. And indeed, we had 10 years where the term premium was negative, it was very low. And it's sort of like normalizing closer to historical levels. As we're moving from sort of like QE to QT, that is something that would be expected at some point. Is this exact timing the right timing? Is debatable, of course. Of course, the other factor is that when you think about these 4 years since we last met, debt to GDP globally has gone up quite a bit, right? So in advanced economies, our estimate of the delta in terms of total debt as a fraction of GDP due to COVID is about 25% of GDP. So global debt is about 25%, or global sovereign debt in particular, is about 25% higher than it would have been in the absence of COVID. And for emerging markets, it's 15%, and for low-income countries, it's much smaller. But that's a lot more debt. So there's both a supply and demand side that is playing a role here. Now, in terms of how central banks are going to react to, say, stress in markets, of course, it's somewhat dependent on central bank objectives, but clearly central banks have an inflation objective. And most central banks have an explicit financial stability target. So, it's expressed in different ways in different jurisdictions, but market functioning is clearly important. So I would distinguish 3 things. So one, you use monetary policy, meaning moving around interest rates. You can use asset purchases, meaning more, in some indirect way, moving around term premium, and you inject liquidity to stabilize market functioning. And so the combination of those 3 tools has been used in a very effective manner, I would say, in the recent 4 years, right? I would argue that central banks were very forceful and, that really cushioned the global economy from a potentially much more dramatic downfall in global activity. And of course, fiscal policy was also very, very forceful. But the thing on the monetary side, it was very, very clearly aligned with the objectives of the central banks. So I don't think, I think you have to think about what is the goal of central banks, and then think about potentially future shocks and what would central banks do, i.e. what are the reaction functions, what are the policy functions. And I think, we understand the playbook that has emerged, since 2008, fairly well in terms of the central bank toolkit.
Is it possible to, and after this I'll go on to a question from the audience, which is relevant, but going on the subject of term premium, is it possible to break down the increase, the part of the increase in term premium which is related to fiscal risk and perception of fiscal risk? Is it possible to break that away from the QT part or the lack of QE?
So I haven't done this, or my staff hasn't done this to date. I have seen studies that sort of like regress term premia on some explanatory variables, and but I haven't done that myself, so I hesitate a little bit. But it seems reasonable that there's something about asset purchases, which is the goal has always been to lower term premia. There are different estimates in the literature from 50 to 100 to 150 basis points or so. what exactly the level is. I think there's some uncertainty, but it is in the ballpark of the adjustment that we have seen. And clearly supply of bonds is going to have some impact on term premium. I think there's quite a bit of literature on that, but having exactly the causality and the magnitudes and the timing, I think this is where it gets it's always a little bit more difficult to exactly pinpoint causes.
A much more straightforward question from someone in the audience. Do you think that risk assessment is reassessment is pretty much done, or do risks continue to be underpriced?
I'm happy not to be in the business of forecasting asset prices, so I will refrain from that. It's hard to forecast. It could go up, it could go down. We can calculate the distribution, but I don't want to give you a forecast at this point.
How much of this increase in yields is doing the Fed's job for it, do you think, in terms of monetary adjustment?
So, as I said earlier, markets, implied an easing of financial conditions as interest rates went up, and we felt somewhat uncomfortable with that. So I think the direction of travel is actually making us more comfortable that monetary transmission through markets works, right? So there's monetary transmission through bank balance sheets, right, where banks adjust lending standards and rates. And there's transmission through markets, which in countries where non-bank credit remediation is quantitatively large is particularly important, but also in other countries tends to be quite meaningful. And so we feel that this tightening of financial conditions is more aligned with monetary policy transmission. To what extent that is or is not impacting the stance of policy on the margin, is a bit of a judgment call, right? And I think it's somewhat debatable. So we don't have a definite view at this juncture. It is dependent on countries. Our advice to central banks is to stay tight until inflation is durably back to target, and to tighten if necessary to get there. I think as I said at the beginning, the direction of travel of inflation is in the right direction, but it is it is still we're not back to target in most countries. So I think a sort of like bias towards staying tight and potentially tightening if there are further shocks makes a lot of sense.
Just moving to the broader economic cycle, one interesting point in the stability report was a mention of the fact that lots of borrowers have extended maturities. They took advantage, piled into the markets when rates were low, and so monetary transmission is taking a bit longer than in the past. At the same time, there are other changes in the economy in the sense that private equity deals have added significant floating rate debt to corporate sector. It's a slightly different makeup. What are the best historical analogues for this cycle, do you think we should compare it with? So I think you're on mute again.
I keep muting to make sure that I don't make any
I should do it
while you're speaking, but then I forget to unmute. I'm so sorry about that. So I wrote an article a couple of years ago where I talked about the move from shadow banking to market-based finance. I think we're in a very different situation today than we were 15 years ago, where what I call the shadow banking system and others call the shadow banking system was a large part of financial intermediation. And that shadow banking system was really about outright capital arbitrage, i.e. banks using off-balance sheet entities with credit transformation, liquidity transformation, credit lines, maturity transformation, etc., money market funding of long-term risky assets, as a capital conservation and return maximization vehicle. And that doesn't exist anymore. So I think we're that much safer because that doesn't exist. I think market-based finance has grown massively. I think the jury is still out to what extent the growth in non-bank credit intermediation is directly causally related to tighter regulation. I mean, it is very much related to the US, right? In Europe, you haven't seen that. In continental Europe, you haven't seen that trend as much. There is some trend, but it's quantitatively much less pronounced, right? So it's not that easy to just say, oh yeah, here's this and then there's that. But so we do have a lot of non-bank credit intermediation. There is more opacity there, right? So we know a lot about investment funds, right? Open-ended funds, mutual funds, ETFs, etc. There's a huge amount of data. This is, well understood. There's some debates about, regulations. There's some work domestically in many countries and at the international level, but that is fairly well understood. Private loan markets, private other private bond markets or so are perhaps a little bit less understood. And in particular, there is this nexus between private equity, as you allude to, and these private loan markets that I think we are looking into much more at the moment. My understanding is that private equity firms do quite a bit of the monitoring that normally banks are doing for credit. And that's a good thing, is that there's active monitoring of these credits. But the magnitude of leverage and maturity transformation is certainly much lower than in banks, right? So these are generally is credit transformation without explicit backstops, without discount window access and deposit insurance. So there's much less leverage, much less maturity transformation, but there's some, and having a better understanding of that is work we're doing right now. So we hope that in April we'll have a much more granular view. So I think as I said earlier, there's some deterioration in credit, but at the moment, it's something we're watching, but we don't see as acutely systemic or so. Of course, there is commercial real estate, and that's around the world. There's a structural change, right, in shopping behavior and in work from the office. I'm in my office. I'm in my office every day, but many people are not, and that is clearly a hit to CMBS. There is quite a bit of refinancing of CMBS that is coming due. So I don't think it's an acute stress, but over the next coming years, there could be readjustments. So we are modeling CMBS prices at risk, and we calculate that there could be a further 10% adjustment under an adverse scenario, not in the central scenario, but there's certainly risk there. And there's exposure, but I think it's watched very closely by analysts and policymakers alike.
Actually, I was going to I'd noted down that 10% potential adjustment in commercial real estate already. For an adverse scenario, and given I'm in a part of London where the changes since COVID are really apparent. When you take a train in the morning and you see all the offices and so on, it's quite obvious. Isn't a 10% adjustment fairly benign for an adverse scenario, given the extent of these changes? And if so, what would that mean for everything else, given the exposure to commercial real estate?
It's an average across many different classes of CMBS across different countries. So there's some segments that could see a much larger decline, and in some areas in particular. So, as you're alluding to, office space in metropolitan area maybe under more pressure than other forms of commercial real estate. So it is somewhat dependent. So the 10% is an average across the sector, and it does come on top of some decline already. And of course, that is sort of like using historical data, but if there were financial stability concerns, that could compound this kind of assessment.
So, I mean, I suppose that lots of people ask you this question, and it's probably always impossible to answer. But in the sense of as you go to bed at night, given your responsibility for global financial stability, or your overseeing of this, what are the one or two things that worry you the most? We've spoken about banks. There's the non-banks. There's
so. I do think the banks, the turmoil has been a wake-up call to some degree, as it put the focus not just on capital and liquidity in the banks, but also on the importance of backstops, right? So when we look across, when you think about the history of banking, right? I mean, banking didn't work terribly well. The Bank of England was transformed from a private institution into a central bank to backstop the banking system. Central banks around the world were created to backstop the banking system. And even that wasn't enough. It was only once deposit insurance was combined with these central bank backstops that banks started to be stable. So, these emergency facilities in terms of deposit insurance resolution regimes and central bank backstops are extremely important. And there's quite a bit of variance across countries in terms of how collateral is prepositioned, how much collateral is prepositioned, how collateral is valued, what emergency powers central banks have, how much deposit insurance there is, what's the ability of backstopping uninsured deposits, how the resolution regime works for the largest institutions, but then also for small institutions. So I do think that has come more into focus. We do a lot of work on these resolution regimes and crisis management tools, but I have become a little bit more acutely aware of the heterogeneity of practices and abilities to act swiftly. And I think, you can debate whether there should have been more capital or more liquidity in the institutions that were in turmoil in March, but definitely the authorities acted very aggressively, very quickly, and were able to contain the fallout. And so I would always look at capital and liquidity in the context of these backstops. And that's also true for non-banks, right? I mean, clearly there is maturity transformation and liquidity transformation and credit transformation. The three things that banks do is also to some degree done outside of banks. And we have seen again and again that central banks have had to put into place emergency liquidity facilities, and sometimes treasuries have had to put in place credit lines or so to backstop non-banks as well. The Bank of England, of course, recently came out saying that they were studying more of a standing facility. I mean, even the Federal Reserve now has a standing facility that has been broadened for repo. It's not available it is available to primary dealers at the banks, and not to all banks, only to some banks. but presumably, some of this liquidity can be passed on. So, backstops are extremely important to think about financial stability. So this, I think, is one segment. The second segment is the nexus between fiscal and financial stability. As I alluded to earlier, debt in the world has been going up, and that has to be financed. And our estimates of R star, so futures are like real short rates, haven't really increased, but the term premium has increased. And to the extent that governments don't borrow overnight, they borrow with an average maturity of 7 or 8 years or so, depending on the country. These longer term premium do matter for real borrowing costs. So I think as you look across different countries, so like total debt is high, and that could put pressures in principle on countries. But then there's the nexus. So for example, 2 years ago we looked in great detail at the bank sovereign nexus for emerging markets, and of course we all remember the European sovereign crisis, which was very much about this nexus. So I do think it's something to continue to sort of think about. It's not sort of like an acute risk, but I think there will be more pressures. And our first order advice is not so much about financial stability, it's more about fiscal, right? It's about, putting fiscal rules in place, containing, keeping that sustainable. So at the IMF, we do a lot of work on fiscal sustainability, and fiscal sustainability can feed into financial stability issues, because banks and non-banks have high exposure to sovereign debt.
You refer to the famous doom loop of the European debt crisis in 2012. So this is still an issue. But in what regions are you most concerned about that sort of that sort of feedback loop?
So I think Europe is in a much better place now.
Yeah.
I do think most countries have had an adjustment in the fiscal position. Of course, COVID has seen a jump up of debt, as I mentioned, and that's fairly broadly spread. But of course, banks are better regulated. Stress tests commonly take into account this feedback loop. And of course, the ECB has new tools and has, really a much broader toolkit now. So I do think that Europe does look pretty good. I think in general, across countries, it's more of a general statement. So I don't want to go too specific into countries. I think it's just at the global level. If you just think about global debt to GDP, the fact that our star perhaps remains low. So we had a chapter last year in the World Economic Outlook using sort of macroeconomic models to estimate our star, and they are fairly benign. Market applied R star, which is kind of like a far in the future forward rate. So forward rates are sort of like market applied short rates, adjusted for real term premium, is still fairly low. But again, the real borrowing cost is more like a 7 or 8 year duration, and that has come up with real term premium coming up. And at the same time, global growth, as I explained at the beginning, has come down quite a bit. So when you look at the IMF's global growth forecast, that has come down, on a linear trend since 1990, basically, for the global economy, right? And so if you just think globally, right? So now you have growth rates that are going down, R star plus some market risk premium going up, and then debt to GDP that has come up quite a bit. There's more sort of like possibility for pressures.
I'm going to just ask a few questions from our audience, because we've got quite a few coming in. Someone asks, what impact might ESG regulations have on bank capitalization?
ESG regulations on bank capital. A priori, I don't think there's much of an impact there. So, we are doing more climate stress testing. So asking to what extent physical risk or transition risk can make the loan book of financial institutions more risky. Now, this is taking today's book and asking, if you have find the future evolution of physical or transition risk, how would this current loan book be hit? Of course, banks are dynamically readjusting the loan book, and so this is getting to incentivize banks to think about how to adjust the loan book relative to these structural changes over time. So, but this is not per se a regulation. This is more in the realm of supervision, it's similar in some sense to other structural changes in the economy, right? I mean, if the economy is aging or an economy is moving from agriculture to manufacturing or from manufacturing to services, right, that is going to impact performance in the loan book. So it's not per se regulation that is aiming at transition or anything like that. In terms of regulation, right now, there's not really, there's only thinking around that. But, of course, in insurance companies, for example, physical risk exposure has always been part of insurance risk modeling. It's extremely important. The catastrophe bonds and as physical risk characteristics are changing, the pricing and the risk assessment of those things are going to change. And that's very apparent in some countries where climate, the physical risk incidence has been changing, and that could expect it to continue going forward. I think what is perhaps more relevant is the climate information architecture. So that is more of a security market regulation issue than per se a banking regulation. So this is really about collecting data and disclosing about to investors about climate exposures and how carbon intensity, for example, in the production chain is used by a particular company or so. So I think the work on data disclosure and then classification. So how do you think about these different disclosures in terms of, say, carbon intensity? I think this is where there has been a big push that is in the process of being more regulatory. It's about, security market disclosures. And I think that is more aligned to regulation, but it's not per se regulating to do this or that. It's about disclosing to give investors choices in this or that direction.
I'm just going to continue with a few audience questions. There is quite a simple theoretical one. There's a debate over whether the transmission mechanism is for monetary policy is shorter or longer than it used to be. Do you have a view on that?
It's a hard question. So, this shock has been both about demand and supply, both in the run-up and in coming down, right? So when you look at the simple supply chain indicator, the New York Fed has a nice supply chain indicator that's being published, that went up and then it's coming down. So there's certainly one contribution, and that's a bit different previously. Of course, oil prices have come up and they have come down. Food prices have come up, they're coming down. This was similar to the 70s, but of course, the substitutability has changed quite dramatically. So I think on the supply side, you have to put a lot of care into understanding how much demand relative to supply you need. What is somewhat unusual is the strength in labor markets, right? So we are seeing inflation coming down while employment is very strong. Some of the labor market indicators are pointing towards somewhat less tightness, right? So vacancy ratios are coming down a little bit, but they're still pretty high. Some of that is about rotation, right? So as we went into the pandemic, there was a rotation away from services into manufacturing. Now there was a rotation in many countries, not in all countries, from manufacturing back into services. So that has certainly an impact on total employment. But it is really ongoing study. I do think, as I showed in the charts at the beginning, we are heading in the right direction. Inflation is coming down, total certainly, but also core is coming down. And, this might be the first time ever really to see a global soft landing relative to a pretty pronounced inflation period, right? I mean, that is a huge achievement. This is every central banker's dream, is to be able to bring inflation down without causing a recession. And when you look at the historical data, this is very difficult to achieve, particularly in such a global, shock environment.
Well, it's funny you've said that just in time for the next question from an audience member, which is, what probability do you assign to the adverse scenario? And can you be more precise on what the adverse scenario looks like, and how much long rates go up in an adverse scenario?
Yeah, absolutely. So in the World Economic Outlook, which I started talking about, there are many sort of qualitative descriptions of what could trigger an adverse scenario, right? This includes many different shocks, right? And so in financial stability, what we tend to do is to think about vulnerability. So what is the level of asset valuation, the level of leverage, the level of maturity transformation that could trigger a reversal if adverse shocks hit? So asset valuations might come down another 10% or so. There could be disorderly deleveraging. There could be, these runs. So these are all the vulnerabilities, and then we sort of say, well, there could be many shocks. It's important to monitor the vulnerabilities. Of course, you need to do both, but conceptually, thinking about shocks versus thinking about vulnerabilities, I think is quite useful. So to get these forecast densities, we use this growth at risk methodology, which is conditioning on macro variables, but also on financial conditions and financial vulnerabilities. So what we've found, and we've done a lot of out of sample verification, testing of these models, what we find is that the nexus between real and financial activity is very significant in terms of the downside risk. And so, we have this 5% chance of zero growth as a quantile. So this is kind of like a value risk type of approach for global growth forecast. And then you can track the time series of this fifth percentile. But of course, there are other ways to look at this quantitatively. So the key finding is that you do have quite a bit of left tail risk relative to the historical distribution.
And in terms of right, okay, well, I'll move on to another question, entirely different question, which I've got from the audience, and this is one which the report goes into in some detail. Well, the second part of it is, the first part is, do you have any idea of the impact on bank portfolios from mark-to-market bond losses so far?
Yeah, so again, in this chapter 2, we put a lot of effort into estimating that. And in some countries like the US, these unrealized losses are disclosed, right? They're in the public domain, right? So it's not, they were in the public domain, well before the turmoil of March, right? You can pull the data from the FDIC, the unrealized losses, so you have a precise number. So in the US, the number hovers, I think, around 600 or 700 billion. So, just to put that into context, you have, say, roughly 20 trillion, perhaps 19 trillion of total assets, right? So this is roughly not quite like GDP. So it's about, 1-to-1 in terms of total commercial bank asset size, and so this is the commercial bank subsidiary of the banks, and GDP. So about 19 trillion, I think. You have about $2 trillion of capital, so 700 is a lot. But on the other hand, you have a huge deposit franchise. So when interest rates are going up, banks have these losses on the asset side, but they also make a lot of money because they pay depositors a lot less than what they earn on the asset side. And so, if you just sum up roughly the profits from 3 years of the deposit franchise, that covers more than enough of these losses. So for the system as a whole, sort of like, yes, you have losses on the asset side, but you have massive profits on the liability side. It doesn't look that bad. And when you look at market to book ratios, right, they haven't sort of like collapsed or anything like that, because the market is looking at both the asset side and the liability side. Now, for any one bank, of course, they can be different depending on business models. And I just want to point out that, SVB really was an outlier, in its business model, right? I mean, it was very different from other banks in terms of the amount of unrealized losses and the magnitude of uninsured deposits.
A completely different type of question from someone else in our audience, who is asking about the impact of AI and its impact on banks, and whether that could affect senior level employment, and whether that would have any implications. I don't know if this was a question from someone particularly worried about this. I have a question. Would that have implications for financial stability? How do you assess AI in financial stability?
It's work in progress. I would, distinguish 3 issues. So one is the employment issue that you're asking about. So, economists in the research department here at the fund are working on papers that will come out shortly that are trying to sort of like understand to what extent AI is substituting or complementing, and to what extent you sort of like still need humans. So, for some tasks, you just have a substitution between AI and people. But for other, like for economists, right? So economists presumably you can run with machines quite well. But other things, you may need to sort of like combine the two. This was a joke, sorry. So how much of an impact on employment this might have, I think, is one big question. But of course, the policy framework is extremely important, right? I think Jamie Dimon recently said that, well, we may be moving to a 3-day work week, right? So, there's one possibility that, a lot of people are unemployed, or that we all work a lot less. And that is going to be dependent on policies. And of course, society will look very different if, we trigger a lot of unemployment rather than, reducing time to work drastically. So I think this is one question, is the impact on employment. The second question impact on productivity. And machine learning has long been used for trading, right? I mean, there are many quantitative trading firms and dealers, have quantitative models that are using particular versions of AI, which is machine learning. That is very widespread. I mean, the high frequency trading, that is very much, the marginal market maker in on-the-run treasury securities and liquid stocks. I mean, this has been going on for many, many years, right? It's extremely high frequency trading. It's very automated, and it has proven, very stable, subject to some regulatory, shifts. Remember, there was the flash crash some 10 years ago in equities, and so, trading rules were changed. But then I think the third thing, and then of course generative AI, I think, is in the process, right? So combining language and quantitative data, I think this is in process. However, there's also, AI can be used for bad purposes too. So cybersecurity attacks can be that much more sophisticated. And it's not just AI, it's also computing power. So I think we may see a lot more efficiency in the financial services, but we also may see a lot more threats. And so, on the one hand, you may generate more income, but you may also have to spend a lot more money to remain safe.
Okay. Right. Well, do we have time for just one more question? This would be local government financing vehicles in China. Today we've had the Chinese announcing yesterday, another very significant stimulus. In the financial stability report also called for a comprehensive effort to resolve the financing vehicle problem. What are the chances that this turns out badly and spills over globally?
So I think if there wasn't policy action, I would be quite worried, right? Because housing markets are declining, the kind of growth model in China is shifting, and there is exposure of both local governments and small institutions to the housing market. But of course, the government is very focused on these issues. They're taking aggressive steps. I think, of course, I showed you this regional dispersion. So you have to figure out exactly how to provide support without distorting moral hazard incentives, etc. So, it's a complicated problem, but I think the authorities are very focused on that. And, while, of course, growth rates in China are lower today than they were 10 years ago, so they're still very high in comparison to many other countries. So, so in that sense, I'm cautiously optimistic that, there will be a good outcome. Now, is it going to be a good outcome for every province or every city and, every household? I don't know. But from a macro point of view, the authorities are very focused on containing the fallout and transitioning to a growth model that is less reliant, say, on housing investment and more reliant on other types of investments.
Well, thank you very much, Tobias. I think we've run out of time. An enormous thank you to you for joining us today and helping us on financial stability risks, which are, of course, everywhere in these extremely uncertain times. I'd also like to thank our audience, to thank everyone for joining us, and thank those particularly who've sent us questions. I invite you all now to please disconnect. We at MNI wish you all well, and Tobias, thank you very much once again. Thank you.
Thanks so much.
Thank you.
Have a good day. Bye.